Stocks hitting all-time highs today as Wall Street closes out another record week. The Dow, Nasdaq, and S&P 500 are all at their highest levels ever. But as stocks hit new highs here in the U.S., the best trade may be emerging far away. Check out the Emerging Markets ETF. It hit its highest level in nearly 3 years today. The EEM is far outpacing the S&P 500 over the past 3 months. Driving the action, a nosedive in the dollar. The dollar index has been on a steady decline. It is now at its lowest level since April 2018. So given the backdrop, is it time to rotate out of the U.S. and maybe look abroad for that next big trade? Tim.
Now, this seems like it could be a rerun of Trading the Globe. I mean, these are dynamics that we haven't seen for emerging markets in a long time. And the setup here is the dollar that's been discussed, I guess, far and wide on the network. And certainly, if you look at where the dollar is, if you're investing in emerging markets, one thing you've known over the last couple decades, which is about as long as I've been investing in EM, is that the currency is at least 50% of your return profile. And a number of the high-yielding currencies are certainly one of the drivers of this rally, but that's the Brazilian real, that's the Turkish lira, it's the South African rand. But if you're investing in the EEM, right, Jan 26, 2018 was that blow off top at around 51.75. And I think you've got a case here where you've got rates moving higher, but normalizing. Normally higher rates for EM aren't good. I just think that if you look at the resource trade and you look at a lot of the things that are moving around the world, some of this is about a global recovery, PMIs recovering, in some sense that at least the U.S. dollar and U.S. rates are going to stay lower for longer, and that's fantastic for the rest of the world.
Yeah, we may be in the depths of the coronavirus pandemic here, Jeff Mills, but overseas there is a recovery going on, particularly in Asia, which is a big component of EEM.
Yeah, absolutely. And I think there is opportunity in EM. EEM was actually one of my final trades a couple of weeks ago, and I'm sticking with it. But I don't know that it's about rotating out of the U.S. into EM as an example. I think you can have both trades in your portfolio. And I just used today as an example, right? I mean, we got reasonably weak employment data, but at the same time, small still beat large and values still beat growth and yields were up. So at the same time, I think markets are looking ahead. They're looking to the vaccine. They're looking to the stimulus news that we got this week. So it's a value rotation. It's a cyclical rotation, and that bleeds into EM as well. My only caution with EM is maybe in the near term. Tim mentioned the dollar. I think sentiment on the dollar is pretty bearish right now, so I think in the near term you could have a counter trend rally in the dollar. That might take a little bit of steam out of the momentum in EM. I think if you look at copper, for example, longs in copper are at new highs right now, so that's a decent proxy for how investors are feeling about China, how investors are feeling about global growth. So maybe over the next couple of months you see EM trade sideways, but I think the setup is pretty good here. Tim also mentioned PMIs. November China manufacturing and services PMIs, they're at the highest levels we've seen since 2010. So that's really good news for countries in China's supply chain like Korea, Taiwan, and that's 25% of EEM right there. And then the dollar, of course, I think the Fed remains behind the curve on inflation on purpose. That leads to negative real rates, puts pressure on the dollar. So the setup going into 2021 over the next year, I think, is pretty good.
So positioning might be a problem short term, but the dollar trend longer term, Steve, seems to be lower. I mean, that's what was expected with the Biden administration, on the expectation that there will be more spending, even though Congress looks to be divided at this point. That is what most people are expecting. Dollar weakness ahead.
Yeah, so the dollar, you can't have rates move up as we've seen rates moving up. Even incrementally, the 10-year is very low, but on a percentage basis, it's rallied quite a bit. The dollar, to your point, you have to have one or the other going down for EM. And JP Morgan's out saying that Europe is actually the place to be. So EEM has a large, as you just mentioned, Asian leverage. But how do you buy European stocks? Most Americans or most people that invest here don't want to buy an actual listed European stock. So you buy ones with European exposure. For me, you've heard me mention the names Trinseo, TSE. That one has a 65% leverage to Europe, 24% leverage to Asia. OLN, 45% leverage to international. Capri Holdings, that one's a 45% leverage to international as well. So I get my value exposure, and then I get my European exposure in the same bucket, and that's why these names, I'm looking for them to outperform, as they have outperformed in the last 3 months.
So, Bonawyn, on a relative basis, do you like overseas exposure better than the United States? And how would you have that exposure in your portfolio?
Well, that's a good question. So really, it's not that I would dump the U.S. to invest overseas, but I certainly would prefer to be looking at EEM, FXI, EWZ, which will actually be my final trade, as opposed to moving further and further along the risk spectrum and dumpster diving, so to speak, in terms of sectors and companies that have been impaired from the coronavirus. And that is essentially what we're seeing. We're seeing people moving out along the risk curve and essentially picking up much more speculative businesses that is now trending into impaired territory. So that is what I would steer clear of. With that said, I would also say that there's argument with what we're seeing with the debasement of the U.S. currency, that the risk premium between domestic markets and emerging markets should shrink. And you're seeing that play out in terms of some of the currency appreciation and some of the other names that Tim mentioned. I'm personally looking at names like EWZ, Petrobras Vale, for a few reasons, for the reasons that I mentioned before. But in addition, what we're seeing is reinstatement and uplift from some of their dividends and other ways to pass through value to shareholders there.
Yeah, I mean, Tim, you can go for sort of the double whammy and go for a resource trade that's an overseas stock as well.
So, right, and a Rio Tinto, ticker RIO, which is an Australian company listed in the UK, but is also over here, but has enormous exposure to China. And again, it's often been iron ore and some of the bulks, which is what we call that part of the commodity chain. I think BHP, Rio Tinto, these are trades that we haven't talked about in a long time on this show. And I do think they're interesting, but also look at Freeport, look at U.S. Steel. The steel companies are ripping. And I think the dynamic here is that they were, the balance sheet sensitivity, especially at lower commodity prices for some of these companies, was enormous. The flip side is that they're actually now starting to generate cash flow. So I just, I caution investors because these are more volatile trades. And I think you shouldn't be just dumping everything to be looking overseas. And I've seen this before. I mean, this ratio, do the ratio of the EEM versus the SPY, and you can see how badly emerging markets have underperformed over a decade. And as someone that really likes investing overseas, I caution that some of these moves can be violent, and we've had a pretty good run. Let's break through 51.75 in the EEM. Then I think we're probably going significantly higher.
And by the way, that's how Tim got his nickname, his original Fast Money nickname, the Ambassador, because that is his specialty, emerging markets. Jeff Mills, though, to Tim's point, I mean, this is the story of the markets for 2020, this push out on the risk curve. People are looking for growth. They don't want to all be piling into the MAGA complex, as Dan Nathan likes to call it, the biggest tech names in the market. And so they're looking elsewhere, whether it be SPACs or maybe EM or EV stocks.
Yeah, they are. And to Tim's point, you have to be careful and you have to do your homework. But I do think that that's where the opportunity is. I mean, I'm sure you covered it on the show this week, but just think about Zoom as an example, right? They beat on earnings in every conceivable metric, but at the same time, the stock was down 15% that day. So we're at a point right now where some of those names that people have crowded into, they're just reflecting expectations that are too high at this point. So I think you can look to other areas. I mean, yes, you had a weaker employment report today, but it wasn't all bad. You still had 145,000 increase in transportation and warehousing. Manufacturing, construction employment look good. So I think you can still play areas in the consumer discretionary space. For an example, I mean, consumer free cash flow is still very high, especially coming out of a recession. Debt servicing costs are down. The savings rate's elevated. I just think it's going to be a different industry group leadership profile there. I think it's going to be less about durables and more about more cyclical areas like luxury goods, autos, as an example, just industrials overall, things that are more correlated to payroll growth and PMI increases. And I'll just leave you at this point because we're talking about this widening out rally. Everything seems to be working right now, and people are pointing to caution, and that's probably true. The market might be overbought. But at the same time, you have 93% of S&P 500 constituents trading above their 200-day moving average right now. So yes, near-term overbought. But when you have that kind of momentum, which is in the 95th percentile, you actually tend to have above-average returns over the next 12 months. So I think overall, the market moves that we're seeing right now are actually a good thing looking out into next year.
The NASDAQ is trading 2 standard deviations above its 50-day moving average. Bonawyn, should we be concerned about the overbought levels that appear to be in the S&P and in the NASDAQ?
Certainly, although I will point out that what you're seeing is that on days that we sell off, there tends to be a correlation between mega cap tech outperformance on the downside and value industrial, more high beta names outperforming on the upside. So I would decouple those two. Certainly proceed with caution, but be mindful of the fact that if you're looking for a way to play it more bearishly, that you're seeing that outperformance of tech on the downside.
Shepard Smith here. Thanks for watching CNBC on YouTube.